Last year, you could buy almost any property, go away on holidays, even though you really couldn't because of COVID. And when you came back from vacation, you'd have been richer than you went away. But that was a once-in-a-generation property boom, which made almost anyone who bought a property look like a smart investor. But if history repeats itself, and it most likely will, many investors are going to come to regret the hasty purchases they made last year. On the other hand, at Metropole, we were much more selective in the type of properties we bought. We wanted to ensure our clients' investments would outperform the markets, not just in the short term, but also in the long term. In fact, more importantly, in the long term. So in today's podcast, I'm going to chat with Brett Warren about the type of property his team of buyers agents at Metropole bought for our clients, and hopefully these case studies will give you some insights into how you could choose an investment-grade property. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
While any property can be an investment, just kick the owner out and put a tenant in, not every property is an investment-grade property, one that outperforms the averages over the long term. Most investors buy their properties close to where they live, close to where they want a holiday or retire. But in my mind, that's the wrong way around. Property investment's a process. It's not an event, and the property you eventually buy should be the physical manifestation of a wide range of decisions you make even before you start looking at property. So to help understand what we think makes a good investment property, we're going to give you a peek behind the curtain at a number of the case studies, some properties that our team at Metropole purchased for clients over the last few months. And I'm going to do this today with one of our national directors at Metropole and my business partner, Brett Warren. Hi, Brett.
Hi, Michael. Good to be with you.
Now, we've never done this before, discussed in detail case studies on the podcast, so it should be interesting. Where do we start?
Michael, we'll start at the beginning. And I think for most investors, the beginnings are property. Obviously, as we always talk about, I think that's probably the wrong place to start. I think it probably starts with more of a strategic plan. I know a lot of people do speak to buyers agents, and at the end of the day, they're really just order takers. We have property spruikers that somehow those 300 apartments on their stock list just magically suit everybody. But at Metropole, we do things a little bit differently, as we keep talking about. We like to start with the end in mind. We like to actually start with a plan. Once we understand what your end goal is, we can then put a bit of a blueprint together, have a bit of a strategic plan, understand your financial goals, the timeframes you're wanting to achieve your goals in. Then we can actually work backwards and continually measure and track your progress. It's almost like putting a business plan together, Michael. And I know a lot of our clients are in business as well, and they would sit down every 12 months and review where they're at and where they should be and shouldn't be, and take the appropriate steps to change that. And that's a great way of maximizing your wealth creation. It's a real benefit to our clients because we do help them grow their wealth significantly faster, but also safer than the average investor, Michael. And the statistics prove that.
That makes sense. Of course, it's not the way most people do things. So, yeah, we are going to get into the case studies, but I guess it makes sense to start at the beginning. And the plan, I guess that has various subsections to it.
Yeah, as I mentioned, now we know where we're actually going. And we can come back. And clearly the first part that people don't understand is we have to accumulate an asset base. So the first part's actually getting an asset accumulation strategy in place. I think with property, one of the things a lot of investors miss, and it's something that you can't do with any other asset, it's actually adding value and manufacturing growth. And we always talk about building further growth into the strategy, but also the rental growth strategy as well, because it's going to increase the cash flow. So there's certain things we can do by adding value, but also by targeting certain demographics and locations. And we continually talk about incomes. So that's going to help you with your growth strategy. It's also going to help you with your rental strategy. While we're doing that and getting those types of things in place, it's really, really important to understand if you need asset protection at any stage or tax minimisation. I know a lot of people focus on the short term, Michael, and part of why I invest is to hand assets down to the next generation. So I need to understand that. You can imagine holding a property or a really, really good asset for the next 20 years and then wanting to pass it down to your child. And if it's going to raise stamp duty and taxes and things like that, it can be quite substantial. something you always say, Michael, that it's property investing is a game of finance as well. So you really need a finance strategy. We're not talking about using a bank or broker who will just focus on the short term, but actually has your long-term interests and has some flexibility in mind there as well. And finally, you need an exit strategy, don't you, Michael? So you need to understand how you're actually going to go about getting to your end goal and living off your property portfolio at the end.
Well, that's interesting because to most people, buying a property is a strategy. Investing in property is a strategy. No, it's not. So it's got to be much more detailed than that. And I guess that's the reason why 50% of people who get into property sell up in the first 5 years. And those who stay in the property investment game, 92% never get past their second property. So if you want to be in that 1% who actually do own 6 or more properties, I guess the answer is you've got to do what they do, and that's start strategically. Now, I'm sure listeners want to hear about the case studies and actual properties you've purchased, Brett, and we're going to get to that. But maybe we should first explain what happens once our property strategist has written a plan for a client. How do we then go about selecting what to buy and where to buy?
That's a great question. Again, we're still not looking at the property at this stage because there's a number of, I guess, balls that the investor has to juggle. The first thing is going to be their budget, and that's probably something that's outside of your control somewhat. That's going to be determined by the banks. But, we help beginning investors with small budgets, the more experienced investors with larger budgets. And obviously, we've got a very select group with a high net worth clients that, they all still have a finance limit. They're all still determined by their budget. The second thing is getting the location right, and that's really, really important to us. I spoke before about building and leaving a legacy. So if someone's putting a plan together for the next 10 or 15, 20 years, and they're going to pass it over to their children, we're going to be locked into that location for potentially 30 or 40 years. And we always say the location does 80% of the heavy lifting. So we can't afford to get that wrong. We're never going to compromise on the location. And then the last thing is finding the right property within that location. So that's equally important because some locations are great, but the type of property in that location just won't work. So it's a bit of a balancing act. I guess with regards to finding the right location, it has a lot to do with budget, but our research department is continually looking at different markets and areas. We don't look for short-term, data. We're not trying to pick a hotspot. As I said before, we could be holding that asset for 30 or 40 years. So we've got to look at long-term fundamentals, demographics, incomes, supply and demand ratios to make sure we get that right. And once we do that, our buyer's agents have got your 7-stranded strategic approach tattooed on their brain, Michael, because we talk about it continually day in and day out for the last couple of decades.
Sure. So I think what you mentioned a few times is that if you're in it for the long term, you really need to own the sort of property that you'd be happy to pass on to your kids and your grandkids in 30, 40 years. And if you bought something today that's already 150 years old and tired and not appropriate to the way people live, or in areas where there's not going to be a lot of growth, is that really what you want to pass on to them, Brett?
No, absolutely not. And I guess, look, that 7-stranded approach, I could obviously talk to everybody about that. But Michael, you invented that approach. You use it for yourself. I use it and our clients use it. So maybe I should give you some credit and let you explain it.
Okay, well, to then choose the property once we've chosen a set of suburbs. So it's not one suburb. We're not going to pretend that Melbourne's going to outperform Sydney or Sydney's going to outperform Brisbane in the next 10 or 20 years. But we're looking for locations within those big capital cities, and that's what our research department does, and a group of suburbs. And that's really based on demographics, as you said before. We've discussed that so often in previous podcasts, we won't go into that at the moment, but it's demographics that's going to drive our markets. And then within those suburbs, when we look at properties, they've got to tick a number of boxes. So we buy properties below their intrinsic value. In other words, we don't buy new, we don't buy off the plan, those sort of properties that come at a premium. We buy in areas that have got not just a long history of capital growth, but that are going to continue to outperform the averages. And as I said, it's because of the demographics, because people there are going to have multiple streams of income, higher income earning owner-occupiers and tenants. People are going to want to live there because of lifestyle choices where people are going to be prepared to pay a premium and can afford to pay a premium to live there. So we choose those sort of locations. We buy the sort of property that's going to appeal to owner-occupiers because they're the ones that drive up property prices in general. 70% of property owners around Australia are owner-occupiers. So we look for areas where there is a large percentage of owner-occupiers, and then the sort of property that would appeal to them. Not that we want to sell and appeal to them, but that's what's going to push up properties in the long term in the area. And interestingly, tenants look for those same qualities as well. And then we look for something scarce, an element of scarcity, not just Lego land apartments or houses in the States where there's no shortage of land or they all look the same. Abundance of supply is the enemy of capital growth. So while a lot of property spruikers, marketers will say, hey, look, there's huge growth in this area, it could well be large growth in the number of people living there in those new estates that are being developed, but abundance of supply is really the enemy of capital growth. So we don't want growth of numbers of properties. In fact, we like areas where new supply is limited. Then just getting back to the choosing the right property, we're looking for properties which have got a high land to asset ratio. Now, that doesn't necessarily mean a large amount of land. It means more valuable land because of its location, including the land underneath family-friendly apartments in low-density blocks, because in those good inner suburbs, maybe there's 10, 12 apartments on a block rather than in the newer developments where there's 100, 200, 300 on a block and the land to asset ratio is low. And then I like looking for a property with a twist, something unique, something special, something different, something scarce about it. Hey, maybe we should actually explain how we look for that when we talk about the case studies in a minute, Brett. And then finally, I look for something where I can manufacture growth through refurbishment, renovation, or redevelopment. Now, that doesn't suit everybody's budget, but if it does suit your budget, what that means, Brett, is that you're actually not waiting just for the market to do all the heavy lifting. You're manufacturing some capital growth along the way as well. So that's the seven-stranded approach. But maybe we could have a talk about a couple of real case studies, the properties that your team have bought, and you've got teams in Melbourne, Sydney, Brisbane. They don't fly in, they don't fly out. They're experienced estate agents who know their target market, their areas well. What that really means is that they can bring the sort of expertise that money can't buy. Let's have a talk about one or two of the properties your team have bought recently.
Yeah, good point, Michael. I think we've put the science behind it, haven't we? We've put the plan together for our clients. We've got their budget. We've got everything right. And now it's over to the buyer's agents. And I think they bring a great deal of perspective to the purchase. And I always think the value we add, sometimes it can't be seen up front, Michael. And this is, I guess, a great example from how we help our clients. But I guess to start with, I mentioned before that each year we sit down with our clients, we review their portfolio. So I've got a selection of properties from around the country. The first property, just to keep in mind, is Sydney. We bought an apartment in Sydney. Tracy did a great job of buying an apartment in Sydney in Randwick, in a, like you said, a small boutique complex in a really, really great location. And after 12 months, the average for Sydney over the last 12 months has been roughly about 14 or 15%. We sat down and looked at this particular property, and it had actually done 21%.
So it went in value from 950, because I've got the example here in front of me, to 1,150,000, a 200,000 capital growth in 12 months. Now, that's the sort of thing that most people would never earn in their annual income. Of course, that was an exceptional year, but I think the point is that everyone had a good year last year, but we're showing that you should be outperforming the market rather than doing what everyone else did.
Absolutely. And this gets back to your scientific approach, I guess, Michael, of finding the best location, the best performing suburbs, and then using your buyer's agent to get the right particular pocket and area within that suburb. And that's what our buyer's agents bring to the table from their decades of experience. So that was a great Sydney opportunity that we really outperformed the market in.
Well, it's a 3-story walk-up older block of what in the old days we used to call flats. Just having a look at it, there's 10 apartments in the building, but we wouldn't just buy any apartment in that building. Interestingly, the aspect makes a difference. The outlook makes a difference. Would you really buy one on the ground floor where, in fact, most people would prefer to be on the first floor, but maybe not on the second floor of the walk-up building where you've got to drag your shopping, because those buildings don't have lifts. They don't want to be at the back apartment that overlooks the car park. So even within the same block, the aspect, the outlook, the floor plan makes a difference. And they were built solidly, not out of paper mache as today. So we also look at the floor plan and make sure that you don't fall straight into the living area, but we like a little entry hall. We don't like in the floor plan of those apartments to have the bedroom straight off the living area, because sometimes somebody wants to sleep while others are entertaining. We like to have separate toilets if we can. So that's again a point of difference, something, the twist, to make the apartment more appealing to owner occupiers, but also to
Yeah,
tenants.
and Michael, I'd just say fast forward 5 or 10 years, when all these other paper mache places are falling apart, they're probably only 50 or 60 square metres internally for a two-bedroom. We can renovate a spacious 70, 80 square metre two-bedroom apartment and have a huge point of difference, great deal more space, and it's very, very attractive to those types of tenants you were talking about.
And the outgoings, the body corporate fees are much lower in this sort of complex because you don't have all those mod cons that you're paying for.
Definitely. Moving to Melbourne, I guess, a little bit behind, unfortunately, with lockdowns and extended periods there. Only really did around the 8% mark over the last 12 months. But, David, our buyer's agent in Melbourne, purchased a townhouse in a more exclusive suburb of Bentley East, in the Bay Area there. He purchased that for 1.4 million, and we've just had that revalued at 1.625, and that's almost double the Melbourne average, Michael. It's 7.9% up to 16% growth in the last 12 months in a quiet Melbourne market.
Well, it's bought in an area that you and I know very well. It's an area where we develop a lot of properties for our clients, but some of our clients can't actually afford to do the development themselves. And sometimes we still buy new properties because this wasn't built as investor stock for investors, but for owner occupiers. And on that basis, it's got the strong appeal to the wide demographic that wants to live there, including tenants. But there's a shortage of supply. There's good school zones. There's good shopping. It's 10 minutes to the south, going to the Southland shopping centre, the big Westfield, and 10 minutes to the north, you're going to the biggest shopping centre in the Southern Hemisphere, Chadstone. It's got good, as I said, local shopping, but also transport to trains and buses and a lot of schools. So strong family appeal, which pushes up the value of the property, but we never have any trouble renting those out. And people who rent these sort of townhouses, Brett, basically stay there for a long time. They're not as transient as tenants in apartments.
I think that's a really good example also, Michael. We spoke before about finding the right type of property in the right location. Those townhouses work very, very well in that demographic, in that pocket. But if we were to buy that type of property 20 kilometres out or further out, it just wouldn't work, would it?
It wouldn't. Having said that, I've been amazed that in the outer suburbs of Melbourne, Sydney, and it's starting to happen in Brisbane. The developers are carving up the big areas and building small townhouses way out in the sticks in the outer suburbs because they're trying to make properties more affordable. But this is one of two with its own street frontage, with its own street appeal. Being new, it's also got depreciation allowances, but there isn't the huge margins that developers make trying to sell to investors.
Absolutely. Now, turning to Brisbane, obviously Brisbane's been the standout with 30% growth, which is quite extraordinary, isn't it, over the last 12 months? I guess the next case study is actually a home buyer, Michael. So, not only do we help investors, we also help home buyers. And we purchased this property in 2021 for $743,000. That's their home. Could you imagine sitting there with your home and 12 months later, it's actually now been revalued at $1,050,000, and that's a 41% gain. They've got about $300,000 worth of equity. And interestingly enough, I know that because they had a valuation done and they're actually refinancing to actually come and buy an investment property now. So it's put them in an incredible position.
Isn't that interesting? So the suburb of Tarragindi has a lot of the qualities that our research department finds useful for investors. And even though this was a home buyer, their first home, it's not going to be their forever home. I can see a picture of it that you've given me here, and that'll probably make a good investment in the long term when they upgrade to their other home. But if you buy your home with an investor's hat on rather than an emotional hat, that makes a difference. And interestingly, that's one of the benefits of having a buyer's agent, because it's normal, we're human, whether you're buying an investment or particularly your own home, to get emotionally involved. And a buyer's agent should be looking at your blind spots, things you're missing out on, and preventing you falling into the traps that a lot of emotional buyers make.
Absolutely. And the other case study coming up, Michael, is again, we're in Queensland, but now we're looking at something different, which is a townhouse, slightly different to the townhouses in Melbourne. They're in a smaller complex. There is a small body corporate. And those types of properties are starting to become very popular because people aren't moving further and further out. They're choosing to stay put next to the things we spoke about before. And Camp Hill, we purchased a townhouse just over 12 months ago for $491. That's also just been revalued at $715,000, which is $224,000 of equity and a 46% gain for a townhouse.
Well, as housing is becoming more unaffordable, people are still wanting to live in those locations, but not everyone wants to live in an apartment. So I see townhouses as being the ideal form of accommodation for a much wider range of our population, because you've got your privacy, you've got a modern accommodation on a compact block. No, you don't have a big front, back and yard, and that means that if you've got kids, you've got to go to the park down the road. So the location is important. Camp Hill's a great suburb. It's a gentrifying suburb. You drive down the streets and you see all the old houses being pulled down and new houses and new townhouses being built. But you've also got to be careful where you buy, because occasionally somebody's going to put a big complex right next to you, Brett.
No, look, you're absolutely right, Michael, and that's exactly why we look at the zoning for the areas and the locations. You know, we want to make sure that we're not going to wake up one day and there's 100 apartments behind us and increase that amount of supply. We want purely residential pockets where there's maybe 5 or 10% of areas that can have these types of small boutique townhouses or apartments, rather than the huge zoning reissues that happen in the future.
Right. Okay. So let's go through some more case studies. You've got another Queensland one for
Well,
you.
yeah, look, I guess we could have probably put your property up here as well, Michael, because the properties with the development potential have done exceptionally well in the last 12 months. We discovered a loophole a couple of years ago that properties that were in certain locations and walking distance to certain areas could be developed. And it probably took the market about a year to catch up on that. So, we were buying development sites. This particular site we looked at in Mount Gravatt certainly fit the case there. We bought that for $761,000 in 2021, and that's now valued at 1.125. That's a 48% gain in 12 months and over $360,000 worth of equity.
Sure. So when you're saying development potential, basically there's a good house on it at the moment. I can see the picture that you've shared here with me, a double-story brick house. But it's starting to get by its use-by date. And in the future, because the block is zoned appropriately, in fact, many of these already are on 2 titles anyway. So the house goes down and you build 2 modern accommodations. They're not really even townhouses because they're quite separate, aren't they?
Absolutely. And they're classed as separate houses as well. They're on their own lot, their own title. There's rarely ever a common wall between the two. There's some good space. You've got a nice yard. And again, this type of generation don't want to spend their whole weekend mowing a 800 square metre block. But they like these low maintenance properties where they can have their family and they can spend time with family rather than in the garden.
Now, when we were looking at these case studies, we also found that a large percentage of the properties that we buy are off market. Now, I know a lot of people say they buy off market, but they're not really off market. And in fact, if you go and do a Google search on off market, you'll find Domain and realestate.com, and a lot of estate agents have got off market sections where they show pictures of the property and all the description. Well, that's not off market because I found it on the market. So what really is an off market property, Brett?
Look, an off-market property, I guess most are really what we call pre-market opportunities. Because we've got those relationships, we're talking with agents, maybe we're sitting with them at a building and pest inspection or a pre-settlement inspection, and they just happen to mention they've got one coming up in a couple of weeks and they're going through next week with a photographer, and we might be lucky enough to get an invite to kind of go through and get that all looked at and taken off the market before it even comes on. And I guess then there's the true off-market opportunities where, for various reasons, the vendor doesn't want to sell the property. Maybe it's public knowledge, or, we get the little old ladies and messy tenants who don't want people coming through their homes and want to remain fairly private. So they're the type of ones that we really get a lot of access to. And yeah, so look, last month, for instance, we've bought a number of properties off market. I know in the Brisbane office, we probably get about 45% of those types of opportunities off market because of the relationships and getting in early and types of things like that. I know down in Melbourne, Michael, that Bryce and David, who are looking for a fairly bit of a needle in a haystack, I guess, maybe a development site or one of those unique townhouses. And because of their relationships and their time in the market, they probably get, 70 to 80% of their opportunities off market?
They do. Now, let's be blunt. We're not going to avoid auctions because if a good property goes to auction, we're not going to say, hey, we're not going to buy it because it's not off market. But the way it works with these, pre-market opportunities is really that a selling agent lists a property, and then there's about 2 weeks before it hits the internet. During this time, as you said a moment ago, they take the photos, they do the floor plans, the seller's got to approve the marketing, it's all got to be loaded on the internet. And during that time, if you think about it, most selling agents would prefer to keep the whole commission for themselves rather than sharing it with other agents in the office. So what do? Well, they don't tell the others in the office just yet about it. Instead, they ring their A-grade clients and offer them great opportunities. I've just listed this property. And then eventually they'll call their B clients and then ring anyone else that they know that's interested. They've got a few days to do that. And then they tell other agents in the office who do much the same thing, ringing their top clients. And if it doesn't sell, eventually the property gets listed on the internet and you, the average investor, finds out about it. So I guess the question is, how do you get on the speed dial of these estate agents? And the problem, I think, Brett, to be blunt, is the average investor just can't do it because they're not there often enough. Just because you say, I'm interested, doesn't mean you get to the top of the list.
Look, you're exactly right. I think most home buyers and most investors are lucky enough to probably buy one or two properties in their lifetime, and we certainly did a lot more than that last weekend. So we've got that repetition. We can build the relationships. We've been in the market for a long time. Metropole's involved. What was it? Close to $250 million worth of property transactions last year alone. So you can imagine how many agents we deal with, and that puts us on the speed dial of most of the selling agents, because they know we've got clients, we're on their A-grade list, and we've got people who are ready to buy. We're not going to time waste and waste their time as well.
So while it may be difficult to get that call, you can actually benefit by the special treatment the team at Metropole have. And I guess we've been explaining throughout this chat how we have more than leveled the playing field. We've actually helped our clients outperform the averages. People will wonder, why should I pay somebody to do something I could do myself? Why would I bother paying a buyer's agent when I actually have fun going out on the weekends? And there is a cost involved in using a buyer's agent, which is usually a percentage of the value of the property. But what is the return that you get? You've actually just shown us over and over again, Brett, in these case studies, that outperforming the market by hundreds of thousands of dollars in the first year alone gives a significant return on investment on that investment of the buyer's agent fee, and even more important, the strategy fee at the beginning. But Brett, there's another cost. There's the cost of inaction. Those who are currently thinking, there's so much uncertainty in the world, interest rates are going to go up, they're talking about us having a recession, there's problems around the world, maybe I should sit and wait. How often have you heard people say that when you sit with them, Brett?
Yeah, look, again, going back 12 months, Michael, the people we sat in front of that purchased these properties were saying the same things. But they did take action and they've been rewarded because it was the right time for them to invest, regardless of what was happening around. They had their finance, they were in a position to move forward, and they took the leap of faith and they've been rewarded.
So I guess that's the right answer. The right time to buy a property has nothing to do with what's happening in the external world. It's actually got to do when it works for you. And I think we've seen it before, that it's interesting that in good markets, some investors do really well and others don't. And during difficult markets, some investors do really well and others don't. So it really doesn't seem to have anything to do with what's happening in the outside world. It has to do with what's happening in the inside world, the investor's mindset, the team he gets around him, and actually, more importantly, the fact that they take action. So even if the market does slow down a little bit for a short period of time, that doesn't necessarily mean anything other than, hey, here's an opportunity where I'm not going to be have as much competition moving forward. What it really means is that you can get into the market with a long-term perspective. And I think an interesting thing you said right at the beginning, Brett, is when we put our strategies together, we're not trying to find the next hotspot or time the market or do a short-term deal. We're really looking for the sort of property that's going to be an outperformer in the long term, that we're not going to be buying the Brisbane property market or the Sydney property or Melbourne property market, but we're going to buy the right property in the market that when you look back in 5 years' time, you're going to be saying, hey, I'm glad I bought that. So if you're keen to use the team at Metropole, Brett in particular, why not go to metropole.com.au, leave us your details, find out about what we can do. And remember, we don't sell property, but if you'd like to get the same sort of results, and this is just a small selection of the hundreds and hundreds of properties we buy for clients each year, but the results are pretty similar. In a lot of the cases, you could also get an outperforming property. Metropole.com.au and have a chat with Brett. Brett, before we move on, though, let's have a bit more of a talk about why would some vendors request an off-market sale? Well, what would be going through their head? Because, you and I wouldn't. We know that you can't sell a secret. So if I've got a good property, I'd rather put it up for auction and have strong competition. But some people don't think that way, and we're not taking advantage of those people. We're just taking advantage of the opportunities they're offering us. But what would go through their minds?
It's interesting, isn't it? I got asked that question a lot lately, particularly when you look at the Brisbane market's done 30%. Why would you want to sell it off market? But I guess that, like everyone's got different needs. People are educated differently, and maybe people don't understand the market. But look, I've come across a couple. We always get the people who they really want to save on marketing and advertising costs. They think they can still maximize the value and they don't have to pay for marketing. And I know that's a big selling point for some of the agents when we do deals with them, that they can say to their client, look, if we're selling it off market, you don't have to pay your marketing and advertising. And maybe they've had that objection up front. The next thing is, the need for privacy and not wanting the neighbours or family. Maybe there's a high profile person that is going through a situation that they don't want to know about. So privacy is a big one as well. They don't want to get everyone coming through their home and having that level. Financial pressure, sometimes the need for a quick sale, Michael. They can't wait the 2 or 3 weeks to get the floor plan and the photos, and they need it done today. And look, unfortunately, divorce and death and a change of personal circumstances are also bringing a need for a quick sale. And I guess the last thing, and we're starting to see this a bit more in Brisbane, is people are nervous about auctions, and a lot of potential buyers tramping through their property, waiting for a day, and the nerves getting the better of them. So there's some of the things I've seen.
Sure. So again, they're thinking emotionally, and we're taking advantage of the situation, not the people, because we're not thinking emotionally. Of course, most off-market properties aren't good deals. Agents list them. While we are licensed estate agents, both you and me and our team are, we've never sold property, but we know estate agents buy listings. They actually list them at higher prices, hoping that over time the market's going to convince their vendor to lower their price a bit. So agents entice buyers with inflated prices and then slowly condition them. This means many of the opportunities we're offered just aren't suitable for us. But that's okay. That's just the way the property market works, Brett.
Well, it's just exactly the same as if we're buying an on-market opportunity. We always say probably 4% of properties are investment grade. It's the same when we're looking off-market. Just because it's off-market, it doesn't mean it's a great deal, and you still have to have the structure behind it and the fundamentals and the final tick boxes before we give it the green light.
Now, I think one of the other things that came through as you were giving those examples of the properties we bought were a lot of the properties were bought for interstate buyers. So you said right at the beginning, when we decide where we recommend a client purchases, it actually has to do with their budget. So at the moment, a lot of people just can't afford Sydney or Melbourne. Now, they can if they go to the wrong locations, but investment grade locations in those suburbs. So I think it's important for investors to give up the desire to buy in their backyard or be able to drive by it. Yeah, maybe you could do some renovations or do some other stuff yourself, but that's not the right way to think about things. The trouble is that different states have different real estate laws, different states have different demographics. The way people want to live in Queensland is very different to the way they want to live in Melbourne. So if you are going to be a borderless investor, you really need somebody on your side who's on the ground. And that's where we were talking before about the buyer's agents and the property strategists. It's really bringing the science and the art together. The science is all the homework and the data and the research, but that's not enough. You actually need to know why one side of the street is better than the other or different than the other, or why one particular property will be more popular than the other, Brett.
Yeah, and I think the most important thing there you said, Michael, is the property strategist needs to be independent. There needs to be no vested interest. They need to make decisions for you in your best interest based on facts and data and numbers. And I think we probably used this example before, Michael, but there's a fantastic buyer's agent in Perth who does a great job. But they're never going to sell you or they're never going to advise anything else because it's against their interest. And unfortunately, we've had clients that have had a lot of property in Perth and have used this particular buyer's agent who's done a fantastic job, but there's been no diversification, there's been no recommendation. And I think that's talking against their interest, unfortunately. So I think that's the other thing as well. You know, if you're working with someone in Darwin or Tasmania, you don't get that overall perspective and independent advice.
It's a bit like one of the ones I've read about recently who very proudly says they've never bought a property worth more than $500,000 because that's the way they think. And while that may suit certain people, it means that straight away they've actually avoided whole segments of the capital city property markets because of their preconceived concerns. Again, the strategy should be independent and then get a buyer's agent to implement that strategy. So if you'd like to have your own strategic property plan written for you and your family to help secure your financial future, go to metropole.com.au, leave us your details, find out about how we can help you, and you could have a chat with Brett Warren as well. Thanks, Brett, for explaining what your team have been doing.
Yeah, thanks, Michael. And I think it's a really valuable exercise because we're always talking about the inputs and how we do this and how we put a plan together. But I think we've got some results today and we can actually show our clients how we've really, really outperformed the market. So that was exciting for me.
Fantastic. Thanks, Brett.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to talk to you a bit about success, your success, and I'm going to share with you a little bit about the way I think about success. Now, you probably started this year with some great ideas, some great plans, like a lot of people did, and then all of a sudden, COVID came and life threw some unusual, let's call them curveballs at you. So, how do you measure your success at unusual times like this? What are your rules of success? If you're like most people, you've got some rules, either in your head or maybe you've even got them written down as goals. Now, I remember many, many years ago, 30-odd years ago, went on a retreat on the Sunshine Coast, and I set plans for the next stage of my life and how I was going to build the Metropole group of companies to what they are today. At the time, I pictured what I'd needed to do to become Australia's leading expert in wealth creation through property. I set myself some audacious goals. I remember I made a list. I wanted to become a published author. Remember, this was 30 years ago. It was before I'd written my first of my 9 books. I wanted to have offices of Metropole in 3 big capital cities. Remember, at that time, Pam and I were just working from our home office. I wanted to have 100,000 subscribers to my newsletter database. At that time, I didn't even have a newsletter. I wanted to be in the media. This was before I had regular segments on the radio and TV and podcasts and blogs and all that. I set myself a whole heap of criteria to measure my success. But as my business grew, I had doubts about my success because I didn't fill all those criteria straight away. At times, I didn't feel the success I should be feeling for the levels of achievement that I'd already achieved along the way. At times, I felt doubt. I felt fear. I felt a little bit insecure. Can you relate to this? But then, again, this was many years ago, my business coach at the time asked me to do an audit of my own personal rules of success, and they were exceedingly high. I couldn't go from being an unknown in the real estate community to being the most respected expert straight away. Sure, I'm there now, but that was well over 20 years after that. I couldn't build a database of hundreds of thousands of subscribers in a few years, but I've achieved much more than that now. I couldn't write 8 books, which was my goal at the time, and being in the media straight away. I've written 9 books, and I've now got my own little media company, but I couldn't achieve that straight away. However, what I'm trying to say is, at the time, my audacious goals were unrealistic for me. But the big challenge I had was the word I used, and. The word and to connect my goals. I had to achieve this and that, and that. What that meant was that if any of my goals weren't achieved, as unrealistic as some of those goals were, I didn't feel a success. So the big breakthrough I had, and I'd like to share that with you today, was that I changed my rules of success. The first thing I did was take away the word and. It became or. I was able to feel proud or feel successful if I achieved any of my goals. The next thing I did was set up a whole group of little rules of success rather than just aiming for the big final goal, which meant that any small victory I made along the way made me feel successful. So think about your journey in life, whether it's in property, in your business, in your personal life. What rules have you set for yourself to judge your success? Sometimes they're going to be clear. Sometimes they're going to be unconscious. So what are those crazy, silly, outrageous rules of success that you've set yourself that are causing you frustration? Take time to evaluate them, to reassess them, to reset them, and then make the coming future great. We're moving our way through this pandemic. We're moving our way through the recession. We're moving to the next stage of our economy. It's going to be a great year. We're living in the great country. It's up to you now to have a great week. Make it a great week. Well, thank you for investing your time and listening to Brett and me chat about what makes an investment-grade property and showing you some of the case studies of properties that we've bought for clients. If it gave you some inspiration, if it gave you some insights, if it's going to help you, please think of somebody else who'd get some benefit from this and tell them about the Michael Yardney podcast. Now, there's a share button on every podcast app, usually just down the bottom where you can click and send a link to the show, or just tell them about the Michael Yardney podcast. It'd be doing them a favour, and to be fun, to be doing me a favour, because I want to make as many people as financially fluent as possible. Now, I've got a bonus for you. My way of saying thank you for subscribing to the show. Go to podcastbonus.com.au. I'll leave a link in the show notes, podcastbonus.com.au, and you can pick up a heap of ebooks and reports to help you become a more successful investor. I'll be back again real soon, but you can catch me on social media. Why not go to my private Facebook group? Go to Facebook and look for the Property Update Facebook group. Enjoy, or just look for Michael Yardney on social media. And as I said, I'll be back real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?